Welcome to the broadcast. My name is John Mayfield. My apologies. I was hoping I would be on by 4 o'clock, but unfortunately some things came up and I was on a conference call and I was not able to get on as quickly as possible. But we're here and we're going to do some live streaming. In fact, I have most of my events that I do have been canceled. I did get a new listing this week, and so I'm excited about that. But a lot of my speaking engagements have been postponed or canceled due to the coronavirus, and that's I mean, those things happen, and that's okay. And I thought, well, you know what? I'm going to take advantage of doing a lot of live streaming over the next few weeks. So my goal is every Monday through Friday, 4 to 5, I'll try to do some live streaming. I'm always going to record these, so they'll be right here on my YouTube channel. Please subscribe, and then anytime we go live, you'll be notified, or you can always come back to the YouTube channel, see what we've done. So anyway, my goal is to do a lot of live streaming. I may even come back tonight after dinner and do some more live streaming. And I'm also going to be doing some live streaming over on my Real Estate Tech Guy or Business Tech Guy YouTube channel. So go subscribe to that channel as well. And if you need help finding those, just send me a message. So I'm going to go right over here to my, try to get this going there. I'm going to go right over to my computer. We're going to get right into today's information. So looks like we're streaming okay and everything's fine. I'm going to pick up where we kind of left off. I have a brand new program, My Real Estate Exam Coach. I'm really excited about this. If you purchase the course, or it's a training module, and it works for all 50 states. You basically would see, I see some other things because I'm the owner of a university, and so there's some other training. Depending on what training you purchase would depend on the tabs you would see across the top here. Most people will see the My Real Estate Exam Coach. I'm going to be producing a video that will go on the front page showing you how to use the course. These are the modules. These modules, by the way, are broken down to the same content that's found on the PSI examination. So when you're studying Module 2, Land Use Controls, everything from the PSI exam that they ask you questions on regarding land use controls, that's what you'll find with this module. And then you will also find the videos only. So one of the really cool things that I did with this course is I created a lot of very short, concise videos. There are some longer videos. In fact, there's a couple of longer math videos, but I wanted to produce, I wanted this to be something you could use with your mobile phone or a laptop or a tablet. You could take with you to study for the exam. So there are a lot of short, concise videos where I'm coaching you. And I may say that don't forget between a variance and a non-conforming use, or here's how they may want to ask this on the exam question. So throughout all of these modules are these short little videos that I've done. Well, you can go over here and you can watch, if you go to contracts, all of the videos from the contract section in that module, everything that's under contracts over here, all of the little videos that are sprinkled throughout the course, you will be able to find inside the module tab for videos only. So if you just want to sit down and say, you know, I just want to go through some of those videos, what was that John said about a counteroffer or any of these, you can just watch the videos. You can also watch the audio content. So, or I shouldn't say watch, listen. And so if you want to listen to the audio content,
welcome to myrealestateexamcoach.com.
I actually go through, and we are finishing this up, but as you go through the course, the course here, I actually do the audio for each one of these sections. So that's the audio section over here. And then what we're going through today and what we went through the other day are the flashcard sections right there. And so there's, again, lots of flashcards that you can go through, and you have all of the ability to take this on your phone. Looks really good on a mobile phone, and little short nuggets of information just to make sure you understand each topic and you are ready for the real estate exam. So to me, there's nothing out there like this. I'm really excited about it. It has lots of exam questions too. So flashcards, audio, video, interactivity where you can drag and drop things, and practice questions galore. Over 500 questions I have included with this. And so if you don't pass the test, I've kind of done a soft launch, and some of my current real estate school students have told me it's amazing and they love it. And again, it's designed to take with you on your mobile phone, but to help you pass the real estate exam. So who wants to sit down and just do question after question? We need to take exam questions, don't get me wrong, but you need some short interactivity videos, and you need a coach to help you pass the real estate exam. So my real estate exam coach, go over to globalrealestate.com. You can purchase it. I will have a landing page up shortly on my real estate exam coach, but again, I'm doing kind of a soft launch right now, and just kind of fine tuning and working out some of the bugs and little things, but it's still available for purchase, and I highly recommend it. Okay, well, let's get into the course. That's what we want to do today, and I'm going to close these modules out right here, and I actually want to go into module 15, which is what we did the other day, and I am going to bring this up so you can see that. And we're going to begin the session here, and I'm going to drop down to, because we've already talked about these, I added the continue button in with these, but it does not remember where you left off. However, it's real easy to just kind of go through and select the continue button. I may take the continue button off so that you can just scroll down to where you left off. Just kind of getting some feedback, but some of the students so far have said that's not a problem, and they kind of like the fact that they can go back through it. So we were right here, this is where we left off, on different types of loans. And I kind of quickly went through these, but I want to go through these again with you today, and then we're just actually, I'm going to start tomorrow. I'm finishing up financing here. I'm going to start tomorrow, and I'm going to start from the first of the course, and each day we're going to live stream, and I'm going to go through every module and chapter, and then we'll turn around and do it again. So, all right, so fixed rate loan. What you need to remember about a fixed rate loan is flip the side here. It's a loan with the same interest rate throughout the life of the loan. Fixed rate loan, here's the thing you need to understand. They could ask you for an application question on this. Fixed rate loans are so low today that you probably would be silly not to get a fixed rate loan. However, here's what you have to kind of look at and weigh, and it's an important point, is we talked about discount points. Remember, one discount point is 1% of the loan amount. Good job. Well, sometimes lenders might have fixed rate loans that, let's just say maybe you could get a fixed rate loan for 3.5 or 3.75 or 4% interest. And you think, well, that fixed rate loan might be the route to go. But you might have to pay 1 point, let's just say. Well, on a $100,000 loan, 1%'s $4,000, right? If you bought a $200,000 loan, that could be $8,000. Well, let's just say the same lender has an adjustable rate mortgage that's 2.75% that adjust 2% annually, 5% over the life of the loan. Now, I'm going to bring up my iPad, and I just want to kind of show you something here. So I need to write the number in here as soon as it pops up, and then we'll stream this over, and I'll kind of walk you through this. Because a lot of people say, well, you're goofy if you don't take a fixed rate loan. And my question is, well, it depends. Okay? You might want to get an adjustable rate. And let's take a look at this and see how this works. So let me put this up on the screen. So let's just say, remember that let's just work off $100,000. And it's a 1 discount point. And let's just say that so 1 discount point would be $1,000. I don't know why I said $4,000 a while ago. I was saying a 4% interest rate. I don't think I said 4 points, but $1,000 would be the discount points. All right. Now, at this, you're going to get a 4%, and I need to put this as the discount point, 4% interest for 30 years. And I just realized that my calculator is over at my desk, I think. So let me go get that. My microphone is long enough that I can come over here. And there's my calculator right there. Okay. So it's a 4% interest rate, $100,000 for 30 years. What I'm going to show you could save you or your clients a lot of money, and maybe it won't. We don't know until we run the numbers here. So 4% interest rate, and we did this for 30 years, which is 360 months. So that payment I get is $449.04. I'm going to double check that. Principal. $449.04. My calculator looks like it's doing something strange. Now, you could have a $100,000 loan at 2.75% interest, 0 points for 30 years. Now, with the adjustable rate mortgage, and I'll work this out for you here so you can see that. So we have a $100,000 loan, 2.75% interest, 30 years. The payment here is $408.24. So what is the savings? So we have 449.04 minus 408.24 equals $40.80 savings if you went with this loan here. Now remember though, here's the key part to this. Remember, you paid $1,000 in discount points. So let's take $1,000, what you paid in discount points, and let's divide it by $40.80, okay? So let's do that. $1,000 you paid in discount points divided by 40.80 equals 24.51 months. In other words, you're going to have to live in that home for 2 years before you actually pay back save your $1,000. In other words, it'll take you 2 years, 24.5 months to get to $1,000. Now, sometimes, and I've seen this happen a lot, and this is why you need to have a good database as a real estate professional. You will be absolutely blown away by the number of people you sell a home to who turn around within 12 months and want to sell that house. It just happens. That's why, A, you got to stay in touch with these people after the sale, because they'll come back and do business with you if you've done a good job. And B, have a good database and follow up. That's what we're talking about. So you might say, well, if they turn around and sell the house in a year, then they paid $1,000 for their point they had to pay, and they only lived in the home 12 months, and they're probably going to take a little bit of a hit anyway, unless housing prices are just appreciating. And so here's why I went through this exercise with you. You really need to, as a borrower and as an agent consulting your client, if you have a buyer's agency agreement, remember that fiduciary obligation: care, obedience, accounting, loyalty, and disclosure. You need to take due care to say, let's look at this situation. Sometimes I have people that buy a home from me and they say, we are only going to keep this home for 2 years because we're buying it for our child who's going to college, and as soon as they're out of college, we want to sell it. An adjustable rate mortgage might be the better route. You have to weigh the options, but if you can save a lot of money on closing costs and get a lower interest rate and that payment, you just look at the difference as what we just did here. What are you going to pay if you get a fixed rate? What are you going to pay if you get an adjustable rate mortgage? And I know people will say we plan to live in the home the rest of our life. When I hear that when they're buying a home, I'm thinking, yeah, you're going to probably be calling me very shortly and wanting me to list your house. It's just the way life works. And I have 42 years experience to say I've seen that over and over and over again. So I'm not saying don't get a fixed rate loan, but I'm just saying sometimes it's not always what it's cracked up to be. So fixed rate loan, you're going to pay the same payment over the life of the loan, and at some point, you're going to start here with a loan amount, and at some point, you're going to pay it totally off, whether it's a 15, 20, 25, or 30. Now, can a fixed rate loan ever go up or down? And the answer is yes. Now, some of you are saying, wait a minute, I thought it was a fixed interest rate. How could it go up or down? Well, if your taxes go up, if you're paying PITI, principal and interest, taxes and insurance, if your taxes go up, your payment could go up. If your insurance goes up, your payment could go up. But the basic loan payment, the principal and interest, will remain fixed for the life of the loan. Now, just so I don't have to go out of this iPad right here, I want to go into the adjustable rate mortgage, and I want to kind of go over a couple of things with you that I think are important for you to understand. First of all, with an adjustable rate mortgage, sometimes we refer to these as an ARM loan. ARM, you can see right here, ARM, an ARM loan. I've seen ARM loans that are 1 year, 2 years, 3 years, 5 years. You could even have a 7-year ARM. Now, there are some other things that are with an adjustable rate mortgage. Normally, you get a lower interest rate versus a fixed loan. Not always, you have to shop around, but generally, lower interest rate versus a fixed loan. You normally have a thing called caps, a cap rate. And there are usually two of these. There is what we call an adjustment cap rate. Could be called something else, but it's per adjustment. There's a cap, and then a lifetime or a, over the life of the loan cap rate. So you might have, let's say, a 2% cap rate per adjustment and a 5% over the life of the loan. And I'll work this out for you. Sometimes you can have a payment cap. So we will only raise the payment by 5% max. I'm just using that as an example. And then we also have what is called an index. So what happens here is, let's say you start at a 2.75% interest rate. And let's just say you took a 2-year adjustable rate mortgage. At the end of 2 years, when you get to 24 months, they're going to look at the index right here. And there's all kinds of indexes they can use. And by the way, when you do an adjustable rate mortgage, the lender has to show you what their index is, what it's tied to, and generally is required to show you a historical view of how that index is done over time, so that you can see, is this index I'm tying it to something that could go extremely high or low or whatever. So they will look at this index. Could be the consumer funds index. It could be a lot of different indexes. But let's just say they look at that index, and that index is 3%. Okay? Now again, it's at the end of the 2-year period. They are looking at the index, and the index is 3%. Well, your rate right now is 2.75. So what would they raise your new rate be at the end of 2 years? Probably will be 3%. Now, what they will look at then is they can only raise it 2 percentage points either way. You have an adjustable rate cap. So in this example, and I just lost my screen mirroring, so we'll bring that back up here. I don't know what happened there, but we should be back on now. So what happens here is that they will look and say, okay, we're going to just raise it to 3%. Now, let's do this. Let's say that this rate they tie it to, let's just say that this rate went to 6%, the index. So at the end of 2 years, they look at the index and they say, uh-oh, it's 6%. Would your new rate be 6%? No. But they will take this cap here of 2%. They'll add it onto that. So the most they could raise it would be 4.75%. So they'll go back and look at what's your loan balance and your years left. And they will re-plug in the new interest rate because it's an adjustable rate mortgage, and you will get a new payment. Do you see how that worked? Because the index went up 6%, they could raise it to 6%, but you have a 2% cap, so they can't raise it all the way up to 6%, but they could take it up to 4.75%. Now, the next adjustment rate period, it could go, let's just say it jumps up to 10%. Well, you could see this go up at the end of 4 years to 6.75%. And again, they take the new loan balance, the new number of years left, they would plug that into this payment and get a new payment. At the end of 2 years, you could max out. So the highest this loan could ever go would be 7.75%. Why? Because you have a 5% lifetime cap. Remember that? That's just kind of how this works. So it's going to take 6 years before you could ever reach the max. But let's say at the end of 6 years, this drops down to 3%. Well, your rate would drop down to 3%. See, you could go up or down either way, but the nice thing to remember is you have these payment caps that prohibit it from going too high. Now, here's the bottom line you have to look at is how long are you going to be in that home? And how many points are you going to pay? And is the seller paying the points? And, you're going to have to look at a lot of different variables and then ask yourself, well, if I'm going to save $40 a month or if I'm going to save $23 a month, but I've got to pay $3,000 in points, how many years am I going to have to live in that house before I start getting my money back? And if you look at it and say, it's a 3 or 4 year ordeal, and we just don't know if we'll be in that house 3 or 4 years, then you might want to look at getting an adjustable rate mortgage. That may be the better route. However, if your intention is, I don't want to go anywhere. I love this home. I want to raise my kids here. That's where I want them to go to school. And I don't foresee myself moving in the foreseeable future, then sure, a fixed rate loan might be the route to go. And if you can get the seller to pay your discount points for you, that also might be a huge factor. So just look at those factors, but understand if you're not going to be there that long, then you may not want to spend the extra money to get the fixed rate mortgage. And I have lots of people who tell me that, John, we're not going to be in this house that long. I'm coming here for my job. I'm going to be here 18 months. As soon as it's over with, I'm leaving. But just a lot of things to weigh and consider and think about. Now, the mortgage payment cap, I want to go back to that for a minute. Remember, this had what's called a payment cap. Let's just say that your payment was X number of dollars and it was going to go up 10%. And so now your new payment is a lot bigger. And the bank says, well, wait a minute, we have this. Remember, you had a 5% payment cap. And you say, well, that's pretty cool. I don't want this payment. Give me this little payment over here. That's a little better because that's only going to raise it 5%. The problem is what you should be paying each month to pay the loan off in the required time is this payment. But you've opted to pay the smaller payment. So we're really 5%. I'm going to use accounting parentheses, which means you loss. We're 5% in the hole. The hole, I mean, did you ever see Planes, Trains, and Automobiles? My favorite line from that movie is when John Candy takes over driving and Steve Martin's trying to sleep and John's like listening to that music, do the you probably remember everybody's doing the whatever it is, but anyway, he's trying to take his jacket off and he gets kind of stuck back here. I've been in that situation and he can't get his sleeves out. He's flying down the highway. It's the middle of the night and he finally gets out of the jacket and the car goes spinning around, comes to a stop, and he gets on the road and goes the wrong way. And he's driving the wrong way down the interstate, and people are honking at him saying, "You're going the wrong way." Anyway, if you've watched Planes, Trains, and Automobiles, it's one of my favorite movies my wife and I love to watch. But I always teach this topic, and it reminds me of the people screaming at John saying, "You're going the wrong way." And John just acts like, "Yeah, sure, you've been drinking." That's what's happening with your mortgage in a payment cap. Because let's look at it here. You're losing, you're short. That's, I shouldn't put a loss, but you're short 5%. Remember, you were amortizing your loan, and now you're adding money back to your loan each month, 5%, and you're going the wrong way. And this is what we call negative amortization. And you might see this on the exam. amortization. I'll just scribble that. Negative amortization. You know what I'm talking about. Okay. It was the planes, trains, and automobiles that got me messed up there. But this is another good example here. This is the fixed rate loan, but now with the adjustable rate mortgage, we're adding money to our loan rather than paying it off. Here's the moral of the story. If they give you an option for a payment cap, you want to stay away from it. It's just not a good loan to do. And you need to be real conscious of that, because you're not paying enough money to keep your loan balance to go down. You're adding money back to your loan, and then when you go to sell and you thought your payoff should have been X number of dollars, and you find out it's an extra $2,000 or $3,000, it's because you didn't make the correct payments. So we're going to go back over here to the course, and that's a fixed rate loan, and it's a loan with the same interest rate throughout the life of the loan. And we just talked about an adjustable rate mortgage, and you learned a lot of things there. You can see here on the flashcard, it's a loan that provides the interest rate to go up or down over the course of the loan. Normally, the adjustable rate is tied to an index, such as the Consumer Price Index or the 11th District Cost of Funds, and it can go up or down according to the terms of the loan. For instance, the interest rate might have a 2% cap per adjustment and a 5% lifetime cap. This means that the interest rate can only adjust 2% up or down per adjustment and could never go over 5% of the initial interest rate. So just remember those tips about an amortization, about an adjustable rate mortgage, and remember what negative amortization is. I think that's very important as well. A graduated payment plan does what it says, and some of these, and I might just come back over here, so we'll see if I have to put a code back in or not, but I think I'm going to have to. I guess they do this because somebody in your audience, if you're a teacher, could try to jump on and stream something on your iPad to the group. So here's a graduated payment plan. You start out with this payment, and then every so often, could be yearly, the payment will increase. It allows you to actually build up equity faster because your payment is increasing. So you start out possibly, and you could start out with a lower payment below, and you could actually be in what we call negative amortization in these early years because you're not paying off enough to pay the loan back. And then you get to a point to where you can start paying this back a little faster. So that is a graduated payment loan. This is ideal. Let's just say this is the first. I'm starting to laugh here because I could actually put a dot there. Hey, we got to have fun while we're studying real estate, right? This could be the first 5 years. Sorry. It's 511. Maybe that's a problem there. So, but let's just say the first 5 years, this might be ideal for someone who is maybe a medical student, a doctor, because they've got a lot of college loans to pay back. But after a certain length of time, they're going to have a good practice established, be in a good position where they can handle a higher payment. We also talk about a graduated lease program, and that is, and I actually, one of my branch offices, that's the type of lease I did. They gave me this lower lease payment than the market rate, but then it graduated up after the first year, after the second year it went up, after this year it went up, and then here it got to a higher amount. Now, the interesting thing was, this is over the life of the loan, the average payment that I paid was this. And this is the amount I would have had to have paid when I first opened the branch office. Well, this was really good for me because in those initial years where you're trying to, you're buying desks, you're buying signs, you've got all this new stuff, and you're trying to establish your brand in the marketplace, this allowed me to have a low rental payment. And then by the time I got to where I was making a higher payment, I had plenty of agents, I had established ourselves in the community, and I was able, money was coming in, and I was able to make that higher payment. So just remember, a graduated lease or a graduated mortgage, you're just starting out with a lower payment, and it's going to graduate over time. And the one thing I will mention is, and hopefully this makes sense, you can get into negative amortization those first few years here, okay? So kind of important for you to understand. Okay, so that's a graduated payment loan program, and again, offers monthly payments that are lower than a conventional loan during the first few years. The payments will increase each year by a certain percentage to a point where the payments will then become fixed. Negative amortization occurs during those first few years of a GPP, a graduated payment plan. All right. A balloon note. Now, I want to talk to you a little bit about this because I think this is important. It's also called a partially amortized loan. And I think the best way to do this, and if you do not mind, I'm just going to bring this up real quickly and we will bring those up. So I think I'm ready to go. Didn't have to do the numbers that time, which is good. So I want to talk to you about a balloon loan. This is very important. So if we had a $250,000 loan, this is actually what happened back in during the mortgage meltdown. There were some things going on. And let's say you went and got a 3% interest rate. It was amortized over 30 years. And that payment would be $1,020.60. Now, what happened a few years ago, I think it was around 2012, 13, 14, right when we were coming out of this, kind of a lot of this mortgage meltdown, is people were getting what they thought were fixed rate loans off of the internet, and this still goes on today. And so you think you're getting a fixed rate loan or maybe even adjustable rate mortgage, and they have a 3-year balloon. Now, a lot of people took these because they wanted to possibly pay off credit cards. They were trying to restructure their debt or whatever. The problem, remember, this is a balloon note, a partially amortized loan. In other words, just what it says, it's partially amortized. At some point, the end of 3 years, on the 36th payment, the loan balance becomes due. Now, a lot of these people who bought homes at the height of the market in 2006 and 7, and some of these people had these 3 or 5 year balloon notes, and the market dropped, so they actually owed more money than what they could pay their home off with, and they couldn't go out and refinance their loans, so the banks were foreclosing on the loans, and there was a terrible, terrible ordeal. And there was a lot of things that went on. I have lots of articles I remember pulling and reading at that time. And here's what you need to understand. This also has a demand feature. And I can probably explain this a little bit better. You know, I got my real estate license in 1978 at the age of 18. So I went through the early 80s when interest rates went to 20% and people were unemployed. It was really a terrible, terrible time. So when interest rates started going up, there was this mortgage crisis. And I'm just going to tell you what happened in my little town of Flat River, Missouri at the time, before they changed their name to Park Hills. We had a bank in town, and I'm not going to mention the name of the bank, but I will tell you what they did was they sent letters to all of their loan holders, real estate loan holders, and they basically said, we're calling your note due and payable, because they had these features built in. They were balloon notes or demand notes. And then the next paragraph, and I saw these letters because I want to tell you what, I sat at kitchen tables with men and women I had known all my life, gone to church with, folks that I looked up to and admired in the community. They were great, great individuals, literally bawl their eyes out at the kitchen table because they were losing their home. So the bank said, we're calling your note due and payable. You got to come out. You have to pay your loan off. We don't want your loan anymore. Then the next paragraph down below said, however, if you come in and sign new loan documents, we'll be glad to extend the loan with you. Well, when the people went in to sign the new loan documents, this is a time when people had interest rates that were 6 and 7% interest rate loans, and now they were jumping them all the way up to 18 and 19%. That's really when the adjustable rate mortgage requirements came into play, and you had to have payment rate caps and so forth. So literally, let me just run this example for you. On that $250,000 home, remember we said the payment was $1,000.20. Let's just say all of a sudden the bank said, we're raising your rate to 15%. If I plug in 15% interest and I hit payment, $250,000, 15% interest, 30 years. I don't know why that's not giving me the right answer. Something's going on with my calculator, but we'll do this. We can find this out because I'd like to see if I did this correctly. So I'm going to go to bankrate.com and I'll have a zillion ads pop up, but we'll just do it anyway, okay? And we're going to do a purchase. And we're going to do a 30-year. And I did this at $250,000. And we did that first one at 3%. We'll just say they had a good credit score. And down payment's 0. 30-year. Looks like they're doing something here that I've never seen before. Let's try this. Mortgage calculator. They used to have, here we go. So let's just do 250,000. 3%, 30 years, 1,054. That's what I gave us a while ago, wasn't it? Now, let's raise that to 15%. There we go. The payment would go up to $3,000, like it would go up $2,000. Hopefully you can see that okay. Remember, a while ago we were at $3,054. Total cost of the mortgage $379. If that went to 15, total cost of mortgage $1 million. I'm telling you what, people don't realize what kind of a real estate market we're in right now. I closed houses at 15%. But you can see what I'm talking about, that I would go out to people's houses and they would literally be, crying that they were going to lose their home. So getting back to the balloon note, what if you can't refinance your house? The bank can demand and call that due and payable. And so you really want to stay away from anything that has a balloon note, because it can cause a lot of problems if you cannot refinance that at the end of 2 or 3 years. I've seen this happen throughout my real estate career many, many times. I had it actually happen to me one time, because I always banked at that same bank that sent those letters out to people. I had a very good friend who was a lender there, and he was so good to me. And this was long after those letters went out. And some of the things changed in the mortgage business. And I always dealt with this bank president. And the other gentleman who was in charge was a nice guy, but I don't know, I just never really had a good relationship with him. And both guys are out of the financing business, and they're both wonderful people. I'm just telling you that I had a loan that was a balloon note loan with my friend. He left and went to another bank. The new guy who came in and took over that bank, he didn't want to do business with me anymore. He said that he was trying to get rid of some loans. And I was a good I paid my loan on time and everything else. He just wasn't interested in doing the loan any longer. He was a new guy, was changing some things at the bank, and I had to go and refinance my property at another lender, and it was not a problem. I had it all taken care of. But what if I couldn't have done that? I could have been in a really big pickle or a big mess. So just have to kind of understand that with a balloon loan, you can actually run into some situations or issues, because at some point it's going to come due and payable. Now, what do we call a balloon note? Partially amortized loan. So don't forget that, partially amortized loan. We talked about a growing equity mortgage. This is where a growing equity mortgage, pardon me, I got to hit the flip part, is where you actually contribute more money each month. And so you're trying to purposely pay off your loan as quick as possible. A bi-weekly mortgage is very similar to that. And so you could also get what is called a bi-weekly mortgage, similar to growing equity. It's just going to help you pay off your loan a little quicker. A reverse annuity mortgage. This is also called a RAM note. Very similar, RAM for reverse annuity mortgage. This is where the lender actually sends you a check every month. So we'll take a look at this. It does the exact opposite as a conventional loan. Instead of the borrower making a monthly payment to the lender now makes a payment to the borrower. There are tons of these commercials on TV for senior adults. And it's really a good loan for senior adults, because I got a thing from Social Security the other day, and it said if I retire at 62, this is how much money. Can you believe I'm going to be 60 this year? And which, by the way, my wife was kidding me about the grocery stores in our area are going to allow the first hour for people who are 60 or over, that they can shop first. I don't fall into that category yet, but in another couple of months I will. But I'd rather go shop after 10 and stay younger. But my Social Security that I would get is hardly anything. I don't know how we could live off that. So that's why you have to tell people they must go to Global Real Estate School, okay? Or buy my real estate exam coach. I'm going to have to keep working a little longer. But let's say my house is paid for. I could literally get a reverse annuity mortgage and borrow against my house. So the bank, I could say, send me $3,000 a month. I'm going to get this much from Social Security. I think I'll be fine with that much money. I could always raise the amount up or whatever. But at some point, the lender's going to say, hey, John, you've used up all your equity in your home. I'm going to have to put my house up for sale or start making, this huge mortgage payment to pay the balance down. So here's what happened, and I'm just telling you, I just saw this within the last 12 months. A good friend of mine called me up. I went out to list her mother's house, and her mother had passed away. Her mother had taken out a reverse annuity mortgage. She had no idea her mother did this, and her mother literally borrowed. They allowed her to borrow so much money against the house that I couldn't sell the house because it wasn't worth what the lender allowed her to borrow against. And basically, she literally had to deed the house back to the bank. I don't know if they did that or if they foreclosed, but that's the problem with a reverse annuity mortgage. Again, hopefully you understand the concept. It's really for seniors or others who have a lot of equity in their home and they want to borrow that equity out of their house. The problem is if you keep borrowing and borrowing and borrowing, you could end up owing more than what's owed against it. And my caution is, if you're going to do a reverse annuity mortgage, I would definitely make sure you have a couple of real estate brokers come out, give you a comparative market analysis, and say, what can I sell my home for quickly in 60 days if I need to pay this loan back? And whatever that number is, I would like it 70% or 60%. I think I'd quit borrowing against my reverse annuity mortgage, and I'd start thinking about how to sell the property and make some different arrangements. So just my opinion in that example. But that's a reverse annuity mortgage. Now, do you have what's called a straight loan? And this is an exam question. Trust me. They're going to give you a question, and they're going to say, they're going to doctor this question up with lots of goodies, okay? And they're going to want you to amortize or figure out, well, wonder how much the loan balance went down. Well, guess what? On a straight loan, it is interest only at periodic periods with a lump sum due at the end of the loan term. Trust me, just trust me as your coach and teacher. They're going to have a question about a straight loan, and they're going to doctor it up so good, and you're going to look at it and you're going to amortize and figure out, well, they paid this much down. The loan balance must be this, and that you're going to miss that question because it's a simple, easy question. They took a $100,000 loan out at 6% interest on a straight mortgage, and we don't care about all the other goody stuff in there. I mean, you do want to read it and look at it, but they're going to say, what's the loan balance at the end of 3 years? And you're going to say, it's $100,000. Why? Because it's a straight mortgage. Now, if they say, took out a $100,000 mortgage, 10% interest on a straight note, how much did they have to pay back at the end of 12 months? Well, they would have to pay the $100,000 back, and they're going to have to pay interest on that note. So read the questions carefully. We never know how they could add that. But for understanding a straight mortgage, it is interest only, okay? If you saw that question, $100,000 note, straight mortgage, 10% interest. What was the loan balance at the end of 1 year? $100,000. Okay, so don't miss that. You'll see that question, I'm almost certain. Okay, we're going to go through participation financing. That's where the lender participates in the financing for a share of the equity. You don't see mainly in commercial properties. We worked some of those in the CCIM course. A package mortgage, it just uses real and personal property for security of the debt. You might see that in a new home where you could finance the furnishings and the home. It's usually not a bad idea, and lenders kind of probably should prefer it because you're getting one low payment over everything versus let's loan them money on the house, and then they'd go out and borrow all this money on credit cards and other things to furnish the home, and then they can't make their house payment. So package mortgage just puts it all in one together. Wraparound loan, I don't think you'll see that. That was used years ago when interest rates were kind of crazy and high, but it's in your flashcards here. Open-end mortgage. This is an interesting loan, and there's your notes there. It's also called a future advanced deed of trust, and it actually allows you to go back in and borrow your equity back out of the house. So I have this on one of my commercial loans right now on a commercial property, and have paid quite a bit down. I actually have this on 2 different loans. I forgot about that. I've got a rental that just about paid off, and I have a future advanced deed of trust. And originally that loan was for $36,000. Yes, I know you're probably wondering, can you buy a home for $36,000? In my area, yes. But that rental house is almost paid off. The way it's a future advanced deed of trust or an open-end mortgage, I can go to the bank and say, I'd like to borrow back up to $36,000, and they would do that for me. Now, I don't want to do that, but if I did, I would have to pay that new amount at the new interest rate, but that's a future advance or an open-end mortgage. I have that on another commercial loan that I have that have paid down quite a bit on the loan and is there if I would want to take advantage of that option. So again, that's a open-end mortgage. And then we have a buy down. A buy down is when usually a developer will make a cash down payment to buy the interest rate down. It's kind of like paying points. So the lender might say, look, if you pay 7 points, we will allow you to offer an interest rate of this amount. But I don't, we would see these kinds of loans when interest rates were 10 and 11%, and you might have the going market rate was 11%, and the lender would buy the rate down to 9%, so they could use that as a marketing tool to sell properties in their development. So that's what a buy down is. An installment sale is when, we also call this a contract for deed or a land contract, could also be referred to as a vendor's contract. A vendor's contract. Now, I want you to remember that there's a couple of interesting things about an installment contract that you are going to see on the exam. Okay? So let's go over this. I think this is very important for you. When you have a land contract, also called an installment contract, also called a vendor's contract. Could be different things. So I'm going to, here are the buyers, and here is the seller. So there's a transaction, a land contract that goes between the seller and the buyer. Now the seller holds what we call legal title right there. And the buyers hold what we call equitable title. Now remember that this word equitable right here, it's really your right. Anytime you see the word equitable, it's your right that you have to, I'm going to put in this scenario, to get legal title. If you went to the courthouse, whose name would you find on the record? The seller. They're the legal owner, legal title. So that's going to be who's recorded at the courthouse. However, in this situation, in a contract for deed, who's paying the taxes? The buyers. Who pays the insurance? The buyers. Who pays any repairs needed to the home? The buyers. Well, that would include, what if the sewer line needs replaced? I had that happen one time, and you had to go down the middle of the street and put the pavement back, and it cost me $5,000. That was years ago. The buyers. Who paid a down payment? Probably to the seller. The buyer. And so the buyer's making all of these payments, right? But whose legal name is at the courthouse? The seller. So who runs the greatest risk? The buyers. Why? What if they are making all of these payments up here and paying the insurance, paying the taxes, paying the repairs, repairing sewer lines, adding carpeting? They made a big down payment. They're making all these payments. And then every month they're sending a payment over here to the seller. And the seller, you know what? I'm doing all of this and I never put my allow and show. I am so sorry. I had all this great artwork and I forgot that you can see all of this now. I'm so sorry. But take a look at this. The seller has legal title. I should redo that. And that's such a shame because I was really hoping you were understanding this principle. But you can see the seller here has a legal title. Buyer has equitable title. And I should have looked to see if that thing do that all the time so that I don't miss that. But I'm giving you a chance to kind of soak up what we're talking about here. And what I want you to really understand is the buyers have the greatest risk. Because if they're making this payment to the seller every month and the seller never pays their lender, and the lender will do what? Foreclose. And now this buyer has what? Lost all of their money. And they don't even have a right to get the title because it's now been foreclosed on by the lender. So the seller's out of the picture. The buyers have really lost a bunch of stuff. That's why they're at the more risk. And it's a really sad situation. And I've seen this happen. We had a guy down at a little lake development called Rocky Ridge Ranch. You could probably Google it and just say Rocky Ridge Ranch developer. And this was years ago, so don't want to. Rocky Ridge Ranch is a great little development, but this guy owned a bunch of homes there, and literally he went and borrowed money against these homes because he was the legal owner. But he had sold them all contract for deed. The bank loan gave him the money. He never paid the bank back. The bank foreclosed. And all of these people, there were like 30 or 40 homeowners, lost a lot of money in that situation. I still remember that. It's been years ago, but land contract, installment contract, contract for deed. And again, I want to give a disclaimer. That was years and years and years ago. I'm going to be 60. I've been selling real estate. Rocky Ridge Ranch does not have that problem now. It's a great little lake development. I love to go down there, and it's a great investment. Okay, so want to give a disclaimer there. But years ago, there was a situation that happened like that. Okay, so that's a land contract, contract for deed, an installment contract, and it's kind of a sad situation. See if I can lower this down here, and that way I don't have to. Remember, two things you need to remember for the test. I'm going to put this back up, write this out. Just remember this. I need to bring my size of my pen. Remember that the buyer, that's what we want there. Remember that here's what you need to know for the test. The buyer owns equitable title, the right to get the title, and the seller owns legal title. And the buyer runs the most risk, generally. Okay, buyer's paying the taxes, insurance, and all of that, but at the courthouse, the name's still in the seller. So when we say an equitable right, it's the right to get it when they make the last payment has been made, then the seller gives them the deed to the title, and now they become the legal owner to the property. That's what we want to make sure that you understand there. Okay, bring this down here. Let's go on to the next construction loan. They love this question on the test. You just need to remember that it's used to finance the construction of a new home, room addition. The lender usually advances the money. It's interim financing. I've seen that wording used, interim financing. And the borrower has to take out a takeout loan at the end, or an end loan, to pay off everything. You're normally going to just pay interest on the amount that you borrow, but just remember, interim financing, takeout loan at the end. Blanket loan covers more than one parcel and makes use of a deed of release. Now let me show you quickly, and we're just about done here for tonight. Let me show you this. If you were a developer and you put a road in here, and there was a little cul-de-sac here, and so you had lot 1, lot 2, 3, lot 4, lot 5, and this is lot 6. And so this is the road going in. That's just a little cul-de-sac. Well, you're a builder. You have this platted out. Remember, you have to have the city has to approve your plat as a developer before you can build a subdivision. And let's just say you have this platted out there, all vacant, and you build your home on lot 1. Now, when you took the loan out to build this home, because you needed money to build the home, you also needed money to buy the subdivision and to put the roads in and to do all the surveying. And so you took out one loan as a developer over this home mortgage, and it's called a blanket mortgage or a blanket loan. Now you have someone who wants to buy this home, but in order to sell it, you have to give the new owners good title, don't you? We talk about title insurance in the course. So in order to give good title, you need to get this property released from the blanket mortgage. So the blanket mortgage uses what we call a partial deed of release. So you can go to the bank and say, I've sold track 1. Can I get this released from the mortgage, which is part of this partial deed of release? They would do that. That enables you to give good, clear title to the borrowers. So that's a blanket mortgage and some of the pieces for that there. And then we did a sale leaseback, which was the last one. Sale leaseback is when I own a building, maybe in an industrial park, and I need some capital because I'm trying to grow my business and expand and sell more product. And I really can't get a loan at the bank, and so I sell it to you with the intention to lease it back. Now, it's good for me as the seller because I get my cash when I sell it to you, and I don't have to move. I can retain my location, frees up my capital, and things work great. It's great for you because you get a long-term tenant who's already been in the building, knows the building, and you're going to get income off of that property. So that's called a sale leaseback. Don't forget the private mortgage insurance is when you do not have 20% to put down. The lender will have you take out private mortgage insurance that just insures them in case you default. And the reason they do that is because it's a little more challenging to foreclose on real estate than it is real property. So understand private mortgage insurance is when you don't have 20% or more to put down as collateral for a loan. There was a Mortgage Guarantee Insurance Corporation, they're a big player. At one time, that was a question people had seen. Fannie Mae, Ginnie Mae, Freddie Mac, you can read that information that's in your notes. And we talked about foreclosure sales. So that wraps up all of that information that I wanted to go over on the financing chapter. Well, we've been on for an hour and 13 minutes. I'm going to come back tomorrow at 4 o'clock, and we're going to actually start with property ownership, move forward. Hopefully this is good for you. I'm going to just look real quickly to see if you have any questions. You can type those in, and I'll try to be real conscious of making sure that I go out there and answer those questions. So I do not see any questions right now, but you can always email me if you have questions and I'll be glad to answer those for you. Hey, thanks for watching this video. Be sure and subscribe to our channel. Be sure and check us out at Global Real Estate School. We have My Real Estate Exam Coach. If you're one of my students and you're watching this and I've not added that to your dashboard, I'm kind of doing a soft launch, just send me an email and say, hey, John, could I get a copy of that? I'm one of your students, and I'll put that in your course portal, okay? Hey, thanks for watching. Have a great evening. Stay in, keep studying. Don't get in large crowds, and if you do, make sure, if you do go to the store like I had to today, make sure you're using hand sanitizer and wash your hands and just try to get in and out. Hold your breath. It's hard for me to do, but anyway, have a great evening, and I will talk to you tomorrow. I'll be back on at 4 o'clock. See you then. Bye.